and welcome to this week's educational vlog. I'm Jason Hatley, the Financial Planning Manager at Five Plan Partners, and today's vlog will be the first in a three-part series dedicated to the Secure Act 2.0. So let's start with a little bit of background. On December 20th of 2019, the original Secure Act, short for Setting Every Community Up for Retirement Enhancement, was signed into law as part of the Further Consolidated Appropriations Act for 2020. The original act was intended to promote retirement savings by one, making it easier for more people to save for retirement, and two, incentivizing small employers to provide retirement plans for their employees. The original act included 30 provisions, but there were really only two big headlines, both related to required minimum distributions. The first was that it raised the age for required minimum distributions from age 70 and a half to age 72. And then the second was that for inherited IRAs, it eliminated the stretch provision for taking RMDs and implemented a new 10-year rule. But the original act was never intended to be a final product. It was always meant to be a foundation to be expanded and built upon with further legislation. So on December 29th, 2022, what became known as Secure Act 2.0 was passed into law as part of the Consolidated Appropriations Act for 2023. 2.0 includes 92 new provisions that will be put into place over the next several years. So in today's vlog, we're going to cover some of the more relevant provisions that will become effectively immediately starting in 2023. So if you've heard anything about Secure Act 2.0, it's probably this first provision that we're going to cover. 2.0 further increases the age at which you must start taking required minimum distributions. So for individuals born in years 1951 to 1959, you will not be required to take minimum distributions until the year in which you reach age 73. And for those born after year 1959, you'll not be required to take minimum distributions until the year in which you reach age 75. The next provision I want to tell you about is related to the tax penalty for failure to take an RMD. So prior to 2023, if you failed to satisfy your RMD for a given year, you were penalized 50% on the amount that you failed to take. 2.0 reduces that penalty from 50% down to 25%, and even further to 10% if you correct the failure within a timely manner, which generally means before you file your tax return for the year. The next two provisions we'll talk about are related to expanded Roth options in your retirement plans. The first is a pretty big one. Sponsors of defined contribution retirement plans are now allowed to offer their participants the option to make employer matching contributions in the form of Roth contributions. Prior to 2023, all employer contributions were required to be made as tax-deferred contributions. One item to note here is that this Roth option does not apply to profit-sharing contributions. So the way that this would work is that if you chose to have your employer match contributed to the plan in the form of a Roth contribution, those contributions would be added to your taxable income on each of your paychecks and subject to tax withholding. I want to reiterate that this new Roth option is only available if the plan sponsor chooses to allow it. So you'll need to check with your employer to determine whether and when this option will be made available to you. The next Roth-related provision is related to simple and SEP plans. Prior to 2023, all contributions to simple and SEP retirement plans were required to be made on a tax-deferred basis. 2.0 now allows plan sponsors of these types of plans to allow participants to choose to make both employee and employer contributions on a Roth basis. Again, this is at the employer's discretion as to whether to allow this option within the plan. So you'll need to check with them to determine whether this option will be made available. The next change relates to governmental 457B plans. If you're not familiar with a 457B plan, it's essentially a 401k plan for a governmental employer, although there are a few minor variations in the rules for the two types of plans. One of those differences in the rules was that prior to 2023, participants in a governmental 457B plan were required to make their deferral elections in the month prior to them becoming effective. In other words, if you wanted to change your deferral rate for the month of July, you would have to make an election in the month of June. 2.0 removes that requirement and allows participants to make changes to their deferral rates at any point prior to the next pay period. The next provision probably doesn't apply to a lot of people, but I thought it was interesting enough to include. You're now allowed to provide a SEP retirement plan for any domestic employees, like a nanny, a housekeeper, a personal driver, a private nurse, a maid, anything of that sort. This next provision, again, probably doesn't apply to a lot of people, but it does happen from time to time, mainly in the case of non-safe harbor plans. So prior to 2023, if you made excess contributions during the year to a retirement plan, those excess contributions were subject to the 10% early withdrawal penalty when they were returned to you. 2.0 eliminates that 10% early withdrawal penalty in these situations. If you're not familiar with the early withdrawal penalty, it's a 10% tax penalty on withdrawals from a retirement plan prior to reaching age 59 and a half. But Rule 72T, buried deep in the tax code, allows for certain situations in which this 10% penalty is waived. The first is related to hardship withdrawals for terminal illness. So if you've been diagnosed with a terminal illness, you're now able to withdraw your entire retirement account without penalty. The second is hardship withdrawals for natural disasters. If you've been impacted by a federally declared natural disaster happening on or after January 26th of 2021, you are now able to take hardship withdrawal from your retirement plan without this early withdrawal penalty. The allowed distribution is limited to $22,000 per disaster. It can be recognized as income for ordinary tax purposes over the course of 3 years and can be repaid over the same 3 years to avoid taxation altogether. The next provision is related to a concept you may not have heard of before, a QLAC, or a qualifying longevity annuity contract. QLAC is a type of deferred annuity that allows you to delay payments from the contract to as late as age 85. It allows you to move funds from your retirement account into one of these contracts and effectively delay the required minimum distributions on those funds from now age 73 or 75 all the way to age 85. The original Secure Act limited the amount that you could put into one of these contracts from a retirement plan to the lesser of $125,000 or 25% of the retirement plan's account balance. 2.0 has removed that 25% account balance limit and increased the total to $200,000 that you can put into one of these contracts per individual and defer those funds, RMDs, until age 85. The next provision expands the qualified charitable distribution, or QCD, rules. The first change is that the $100,000 a year limit on QCDs will now be indexed for inflation. The other change allows for a one-time $50,000 QCD through charitable gift annuity, a charitable remainder unitrust, or a charitable remainder annuity trust. If you're a small business owner, you'll probably be interested in these last two provisions that we're going to cover, as they relate to tax credits for small business retirement plans. The first is related to the new plan startup credit. Prior to 2023, if you started a new retirement plan for a small business with 100 employees or less, you are eligible for a 3-year 50% credit on eligible startup costs for the plan, up to $5,000 per year. 2.0 has expanded that credit for employers with 50 or less employees to be eligible for a 100% 3-year credit on eligible cost, again, up to $5,000 per year. 2.0 also provides for an additional credit for employer contributions made to the plan in the first 5 years. This additional credit is subject to a $1,000 per employee per year cap and allows for a 100% credit in the first 2 years, a 75% credit in the third year, a 50% credit in the fourth year, and a 25% credit in the fifth year. The full credit for employer contributions is only available to employers with 50 employees or less. But for employers with up to 100 employees, a phased out credit is also available, being phased out at 2% per employee in excess of 50. Another new credit provided by 2.0 is one for making military spouses immediately eligible for your employer retirement plan. Frequent required relocations sometimes prevent military spouses from ever becoming vested in a given retirement plan. So this provision gives small businesses a credit of up to $500 per military spouse employed for 3 years. In order to be eligible for the credit, you must make the military spouse immediately eligible for the plan within 2 months of hire. You also must make them eligible for any employer contributions that they would have otherwise been eligible for after 2 years of service. And finally, you must make them 100% immediately vested in all employer contributions. So those are the provisions that I thought were most relevant for 2023. I know that's a lot of information. So if you have any questions about any of these topics or would like further clarification or details, feel free to give us a call or email us here, and we'll be happy to get you the information you need. Thanks, and have a great week.